I want to bring on Matthew Luzzetti, Deutsche Bank chief U.S. economist here now with us. And Matthew, I mean, you heard Brian talking through those expectations. On the whole, maybe not a lot of change, but when you dig into it, talk to me about what you're expecting to hear because, we're kind of caught in this strange position for Chair Powell when we saw his earlier testimony in front of Congress mentioning that the fiscal question marks are still there, making it kind of tough for the Fed to see where this recovery goes from here. What's your take?
Yeah, thanks for having me. I think Brian laid it out very well. What we are looking for and where I think all the debate is around is on the balance sheet. We are expecting them to give enhanced forward guidance about QE. We think that they will tie that to seeing significant improvement, substantial improvement on both the labor market front and the inflation front. And I think Chair Powell will go out of his way to make sure that this is not sending a hawkish signal to the market. We did certainly just get some negative news on the retail sales front. We've had an increase in jobless claims recently. There's the high frequency indicators, particularly with restrictions coming back in due to COVID, are looking a little bit weaker here. So I think Powell will make sure to send a dovish signal. The market is also looking at a few other things. One, do they change the distribution of their purchases? So the market, there's some possibility of them extending the duration, which would put greater downward pressure on long-term interest rates. We don't expect that, but that's a possibility. The other is possibly changing the pace of purchases. Again, we don't expect that, but those are the things that the market's looking for.
So, Matt, let's break that last point down here in terms of the duration of the holdings and the size of the holdings. What do you think is more supportive in terms of when you look at where the economy is right now? Which action do you think would be more supportive?
So I think the Fed has taken a pretty clear view that they have done a lot from a monetary policy perspective. They've kept interest rates at zero. The dot plot, as Brian mentioned, is suggesting that they will remain there until at least 2023. They've added significantly to their portfolio of treasuries and MBS, and they had a backstop for all these different markets. The Fed's view is that fiscal policy is now far more important, far more effective in the current environment because financial conditions are very easy. I think that's the reason that they don't either extend the duration of their purchases today or change the pace of purchases, particularly with some positive news in terms of progress on the fiscal front.
Matthew, you mentioned retail sales. I mean, that number came in showing retail sales drop for the month of November, down by about 1.1% on a seasonally adjusted basis. It was down 0.1% in October, which you could say, all right, things are looking worse there. But when you compare to last year, up 4.1%, which is kind of important to mention when you consider the fact that we are still in a pandemic here. How do you weigh that and where we're at in this recovery and kind of maybe how much pressure it puts here on saying, look, you could be supportive here, but you got to compare it to last year and maybe where we're at. And all the expectations coming into year end are still better than where people expected us to be back in March. So talk to me about that.
There's no doubt that the economy is ending this year in a much better place than was feared a few months ago. I think this recovery and the recession itself was just very unique from a historical perspective. There was this big collapse, particularly in the services sector, but you actually saw good spending from households, the housing market, CapEx. All of those things have normalized. The way that I view this is we were expecting some weakness in November, December, and then January consumer spending. That's both because good spending basically overshot. We pulled forward, I think, a lot of the demand that we were likely to see in 2021, and we should expect incrementally that good spending from households is declining. I think far more important is what happens on the services side of the accounts, and there we're likely to see weakness as well, particularly due to the return of restrictions. So restaurant spending is obviously going to be down. We think healthcare spending is going to be down as elective procedures have been pushed off. All that is pointing towards November, December, and likely possibly even into January, some weakness in consumer spending. But as those stimulus checks get rolled out, if they're passed, as additional unemployment benefits hit people's checking accounts, I think that will help to support consumer spending and build a bridge to the vaccine next year.
Matthew, there's been a lot made about this back and forth that we've seen play out between the Treasury and the Fed over the last several weeks or so as it relates to the emergency lending program. Secretary Mnuchin, of course, making the decision not to extend some of those programs. Are we likely to hear any more from Jay Powell today on the outlook of that? And more importantly, with a new Treasury Secretary coming in, do you anticipate that Janet Yellen will restart those programs?
There's definitely, Powell will hear about it. I think he will receive questions on it. And I think he will reiterate what he has said, which was if it were up to them, they would have preferred that the facilities were extended, but that decision laid solely with the Treasury Secretary. I think there's definitely a possibility that they come back next year with Janet Yellen when she takes the position of Treasury Secretary. But we have to be, I think, mindful of that it may be at a much reduced backstop. So if they do renew it, unless Congress acts to provide additional funds to the Fed, they will only be able to be supported by the Exchange Stabilization Fund, which is only about $80 billion in total. So the backstop, will be there. I think the market expects that if there is a sell-off or if there's a breakdown of markets, the Fed will step back in. But we would need Congress to provide a much bigger backstop than this $80 billion that the Treasury already has.
Yeah, we'll see what the latest thinking is again later this afternoon officially. Matthew Luzzetti, Deutsche Bank chief U.S. economist, appreciate you coming on here to chat ahead of that decision.